Testing. Good morning, everybody. How are you? Firstly, thank you for coming this morning. For those who don't know me, I'm Mark Coates. I'm the Vice President of Bentley's IPA team, which is Infrastructure Policy Advancement, which is the in-house think aspect of business. We're obviously looking for the future, and I'm your host today. So I'm really grateful you've come here because this is such a hot topic at the moment. I was speaking in Atlanta on Tuesday, and again, investment, the biodiversity, and the impact finance and insurance are going to have on our markets over the next 5 years was a very hot topic, especially around public-private partnerships. In fact, I actually wrote about that this morning on social media. So with that, I'm not going to hog the limelight anymore. We are grateful for your attendance and thank you for coming. Hopefully you enjoy the office. It's not a bad view today. With that, I'll hand to you, Hayden, and the floor is yours, sir.
Thank you, Mark. Good morning, everyone. So I'm doing your keynote session just after this, but before that session, I have a very special announcement to make. And on behalf of FAST-Infra Group, which I'm a member of, we're delighted this morning to welcome Bentley Systems as our latest member, joining a whole bunch of leading infrastructure investors and other parties to really contribute to making sustainable infrastructure a new global liquid asset class. So we're absolutely delighted with that. Amelia's going to be talking about a little bit more about the benefits and some of the added value that Bentley Systems can bring to the group, but it's through this membership that we will be actively engaging with Bentley as part of the working groups. This is all on the press release, by the way, which I saw this morning. I'm reading from this, but contribute expertise into infrastructure modeling and simulation, digital twins, which I'll talk about actually in my speech as well, which I think is really interesting innovation, and AI-powered asset analytics. This will support FIG's ambition to scale industrial infrastructure financing by linking trusted engineering insights with financial decision-making processes, which I think is absolutely, that interface is absolutely critical. So we're really pleased to welcome Bentley Systems here, and I'm going to just hand over to Amelia just to say a few words, and then I'll come back and talk through the keynote. Thank you, Amelia.
Thank you, Hayden, and thank you, Mark. Kia ora koutou. It's a privilege to stand here with you today, members and supporters and those interested in the FAST-Infra label, united by our shared desire to collaborate to accelerate sustainable investment and climate resilience. So what role can technology play in accelerating the transition? That's the question I get to explore in my role here at Bentley Systems, and it's also a question we're going to be looking at today and through our partnership with the FAST-Infra Group. Emerging and mature technologies, such as digital twins, AI, and smart infrastructure, have the potential to de-risk investment by offering a greater level of detail in the current and future state of assets in the environment and infrastructure that they depend on. They're already enabling a range of benefits at a project level, from cost and emissions reductions to improved engagement and with the community, leading to greater social license on projects, but they're not yet being deployed at scale. And what's affecting this greater adoption? Well, in the research looking at how to scale infrastructure technology globally to support the transition, the Global Infrastructure Hub noted that more work was needed to connect up the infratech ecosystem. That's those who are funding and financing infrastructure, the policymakers, those who are designing and delivering infrastructure, and the technology companies. And looking around the room today, it's really exciting to see that this is a step in the direction of connecting up that ecosystem with those who are here today in the room. So today, like Hayden, I'm going to be talking about a tool that can help us address some of these systemic risks, digital twins, and it is a tool that's already transforming outcomes from infrastructure around the world. And let's start by sort of understanding what that really is. A digital twin is a digital representative of a physical object. It could be of a single asset, of a system, or of a system of systems. So you could have a bridge, a railway, or a city that runs a range of different infrastructure systems going beneath it. It connects information from sensors, design models, and operational systems, giving us a real-time window into how our infrastructure is performing, where the risks lie, and where the opportunities may be. Digital twins aren't just for engineers and planners, though. They bring everyone to the table: funders, financiers, insurers, community leaders, so that we can make decisions better based on real-time data and shared understanding. For those of you who manage funds and investments decisions, it's like moving from a snapshot of your portfolio to a live dashboard that lets you see, test, and optimize every aspect of an asset's performance, not just today, but in the future. And why does this matter? Well, as we all know, and as has been a constant theme across the week, the world's changing, and the risks that we face are more complex and interconnected than ever before. Climate change is not a distant threat. It's here, shaping our weather, our cities, and our economies. Regulations are evolving, and the expectations of our communities around resilience and adaptation and the role that those who are insuring and funding their homes, houses, and assets will play are rising. Systemic challenges require systemic solutions. In complex systems like we work in, transportation networks, city water infrastructure, power grids, each link, node, and flow matter. We saw this, for those of you who may have been travelling over from Europe yesterday, we saw this when a power line goes out with the Eurostar. There's rippling effects across just people's ways of getting home, right through to people's ability to attend events such as this and the NATO conference going on. And digital twins offer us that system-level perspective. They allow us to embrace systems thinking, connecting lifecycle data across every aspect of the asset investment lifecycle. They allow us to model the impact of floods, heat waves, or regulatory changes before we commit a single dollar. They give us the power to test adaptation strategies virtually, reducing costly surprises and supporting more resilient portfolios. Let me share a few examples to put this into context. Here in the UK, the National Underground Asset Registry project, according to their own calculations, delivered a nearly 30-to-1 return on investment by uncovering previously unknown underground utility conflicts through data integration. This is a project that started with the premise of, if we know what's underground, we can keep people safer because there's less likely to be these strike risks that can both bring down whole neighbourhoods and communities from affecting the utilities, but more importantly, affect the safety of the people who are on the ground doing the digging. And with a single use case, they've seen a range of different benefits. In Singapore, a national digital twin is helping the city-state plan for rising sea levels and extreme weather, ensuring that infrastructure investment is future-proofed and climate resilient. Similarly, in Wellington in New Zealand, they're using a digital twin not just to map city rising sea levels and the effects of climate change, but also as a way to engage the community, because it's quite hard for our human brains to grapple with these big changes and big scary changes. But when you can bring to life these changes in a model and allow people to go and see what it means for their day-to-day life in their home, it brings the reality and it can sharpen decision-making. Interestingly, speaking to the person leading on the project, I asked, what's the first thing people do when they get access to this data? And he commented that it's often check what it means for their commute or dropping the kids off at school. You know, it's these simple, what is it going to mean for us as an individual and members of the community, as well as the big picture benefits that it can offer. And in China, on the Chengdu Road Reconstruction Project, they use digital twin technology to detect and resolve conflicts, shortening approval times by 15% and improving public safety. The use cases for investment and insurance community for these sorts of technologies are plentiful, as we've heard. As well as the benefits I've talked about, there's also the enhanced risk management. So this ability to model physical climate risks, like floods and heat waves on assets, and then test those adaptation strategies virtually before committing capital, can really help with the future-proofing of those assets, and whether that's as a policymaker and going in to look at this as part of national adaptation strategies, or whether it's private sector making decisions about where to go in. as well as optimizing financial performance. So by identifying inefficiencies and simulating operational scenarios, digital twins can help reduce energy consumption, minimize maintenance costs, and extend the asset life cycles. And this directly results in improved margins and asset values. In 2022, the UK Department for Transport estimated that integrated network management digital twins could deliver £856 million in value over a 10-year period from improved congestion management and incident response. So they're not insignificant figures that can be brought in through these technologies. And an important topic for this week is the role that they can play in minimising transition risk. As regulations and market expectations evolve, digital twins can allow you to track and demonstrate compliance with ESG and sustainability standards in real time, making projects more bankable and attractive to green and sustainability-linked financing instruments. And that's something that we're really excited to explore through our partnership with FAST-Infra Group, the role that technology can play in reducing some of the reporting burden involved by having easy access to the data that's already captured as part of the engineering and design process. Digital twins also support resource efficiencies, helping operators to cut carbon emissions and achieve energy savings in smart buildings. So these aren't just environmental wins, these are financial wins as well. There are benefits as well around reducing rework and cost overruns. So this early stage visualization and scenario testing not just catches design flaws and environmental conflicts before they're built, but it can also prevent rework and delay, as well as additional benefits like checking accessibility standards. So we'll be speaking later on today about how you can make sure that you're designing inclusive cities, and there's a range of case studies out there. For example, on a railway station program in Tamaki Makaurau, Auckland, New Zealand, where I grew up, they were able to, when doing a rail replacement project, use the digital twin to engage with communities in the space and even offer what it would be like to move through the railway station from a wheelchair before the station was finalised and built, which allowed them to pick up on safety issues that weren't flagged in the design process because real users were able to digitally move through the space before it was physically built. If you look at jurisdictions in which there might be legal challenges to not meeting ADA standards, you can see the real benefits and de-risking associated with that. Similarly, in Cross River Rail in Brisbane, they were able to use a virtual reality digital model to engage with the community, being able to reduce the model down to low vision so that you could see what it is like to move through the space and make sure that the signage and the wayfinding allows people to have the independence to move through and really improve the inclusivity of the infrastructure that we're designing. We're also looking at the role that it can play in supporting standardization and comparability, which is a significant issue that's been raised across the week. Digital twins create a common language and data standard, making it easier to compare and benchmark projects and improve the credibility and bankability of sustainable infrastructure investments. You've got the data there that can be shared. But that's a lot about the technology, and the technology is a solution, but it's just part of things. You know, technology alone is not enough. And what's important about events like this and bringing people together in the room, and as noted by the work of the Global Infrastructure Hub calling for scaling up the InfoTech ecosystem, is that the true magic happens when we collaborate and we have these cross-sector and cross-party and cross-organisational collaborations, where infrastructure technology companies, financiers, insurance, and communities come together and provide certainty about the path forward. We've heard a lot about the certainty of infrastructure pipelines and investment pipelines, but on behalf of the engineering community, I'm also here to call for technology and technology pipelines and technology roadmaps, which is clearly communicating to the sector, these are the sorts of technologies that we're looking to see in policy, in projects in order to access sustainability-linked finance, in order to demonstrate that you are meeting resilience standards. Clear strategies such as what the Asian Infrastructure Investment Bank have put together with their InfoTech portal, which provides a online portal of case studies and company profiles of the sorts of solutions that are available and ready to be deployed across a range of sectors to improve outcomes from infrastructure. We've also heard examples across the week of stipulating within infrastructure contracts to look at technologies that can help with ESG reporting, to look at technologies that are going to help with emissions reduction. And even an interesting case yesterday that I'm excited to learn more about, where specialized insurance policies so that you can use earlier stage technology on an infrastructure project and have insurance there to cover any risk involved so that we can start to scale up and demonstrate some of these innovations faster. So in our membership with the FAST-Infra group, we look forward to exploring the potential of how we get in place principles and ways of developing these roadmaps so that we can provide greater certainty to the market on the sorts of technologies and the role that they can play in scaling up infrastructure investment. So in conclusion, as you consider where to place your next investment, I urge you to look to infrastructure technology not as a nice to have, but as a strategic imperative in supporting the sustainable transition. They can help you enhance financial returns, minimize exposure to climate and transition risk, as well as building trust through collaboration and transparency and that improved engagement with all stakeholders involved. So let's seize on this moment to lead the digital transformation of infrastructure finance and use digital twins to ensure that every dollar that we invest delivers value for people, communities, and the planet. Ngā mihi nui, thank you very much. I'll pass over to Hayden.
Well, thanks, Amelia, for that. I think that is fantastic, and you can see why everyone in FAST-Infra is really excited to welcome Bentley Systems to the FAST-Infra group family. Lots there, I think, you know, to be working on, and really looking forward to some of those, some of that collaboration that Amelia mentioned there. And I think there's a lot of synergies between what Bentley Systems can offer and some of the ambition and outcomes that we're looking to achieve in FAST-Infra group and the FAST-Infra label in particular as well. So I'm going to be talking about the role of the FAST-Infra label and how we can mobilize more investment and capital allocation towards sustainable infrastructure finance. And it's a pleasure to be speaking with you today during London Climate Action Week, which is, as we know, a unique forum at the intersection of climate ambition, financial innovation, and global collaboration. There's a lot of talk around collaboration. I think this forum this week has been absolutely brilliant in fostering that. Although it's been getting to the end of this week, and I think we're all getting a little bit weary. Hope you've had lots of sort of interaction with lots of people. I do feel that these sort of events are a little bit like a festival in a way, to some extent. There's been a huge demand for tickets. This event alone was oversubscribed by more than 4 times. 50,000 people have come to London to take part, 700 events, lots of different stages over the course of a week. And to me, at least, it now feels like we're sort of getting towards the equivalent of the Sunday tea time slot at Glastonbury, otherwise known as the Legend slot. So we haven't got Rod Stewart for you, unfortunately, today. But we do have some legends of infrastructure that will be performing on this sort of boy band set up here. So when the key changes, they're all going to step up. But anyway, I'm just a warm-up act, and Robert will be convening that for you. I want to thank Bentley Systems for hosting us in this fantastic space we've got today, FAST-Infra label, and all the partners here for convening this vital conversation on sustainable infrastructure and financial performance, something I'm very personally passionate about. I also want to thank everyone in this room as well for joining us, because you guys are the agents of change. You guys are going to help us reorientate that capital allocation towards more sustainable outcomes. And as we've said, collaboration is the engine of transformation. But we're gathered here today at a time of profound transformation. The climate crisis is no longer a distant threat. We're seeing biodiversity collapse, right now. And as we've heard in evidence many times during the course of this week, it is a lived reality today. But alongside this urgency is a powerful opportunity to change how we build and finance infrastructure that supports our societies, enables us to prosper. As we reflect on London Climate Action Week, right now at this event, I want to focus on action. So on the theme of action, building sustainable infrastructure asset class is not going to happen just by ticking a few boxes marked ESG, as we know. It's all about designing integrated systems that deliver tangible, measurable outcomes, cleaner air, restored ecosystems, inclusive economic growth. and enhancing the resilience of vulnerable communities. It is through this lens which we must view financial flows and capital allocations for infrastructure projects, because investment is just not about capital allocation. It is about financial returns. It is about what we choose to value, to build, and to protect. However, there is a gap. Around the world, we know that trillions of dollars per year of additional investment is needed to build infrastructure. Estimates vary, but according to the G20 Global Infrastructure Hub and the World Economic Forum, infrastructure investment gap is projected to hit $15 trillion by 2040. And I think is actually pretty low in terms of that forecast if you look at some of the run rates of investment which we've seen last year, for example. So that's a significant number in itself, albeit at the low end. It's estimated that only 5% of that gap can be filled by public finance, and 95% will need to come from private sector investors. However, in some parts of Africa, that ratio is flipped. Climate finance is coming from 95% public sources and only 5% private. So that ratio needs to flip. In April this year, HSBC identified that infrastructure is the fastest growing alternative asset class, yet it accounts for less than 1% of total AUM. Moreover, institutional investors only allocate 5% of their portfolios to infrastructure, despite its clear benefits: stable returns, inflation protection, portfolio diversification. So we know there is a financing gap, but this presents a huge market opportunity for a new era of public-private finance. So this is where FAST-Infra comes in. FAST-Infra was established as a market-led public-private initiative designed to bridge the gap between capital supply and infrastructure demand. It was initially conceived by a coalition of private investors, development bank governance, and infrastructure developers, with investors of more than $6.3 trillion AUM involved in the label's development. Supporters include HSBC, the World Bank, Meridiam, Macquarie, FinDev Canada, and the French and the Swiss governments. So the FAST label itself, so FAST, by the way, stands for Finance to Accelerate the Sustainable Transition. And when I first started on the FAST label initiative around 6 years ago now, we conducted a market review and found a really confusing web of over 55 global sustainability standards and taxonomies in the global infrastructure and project finance market, which is why I became so involved in the FAST label, as all the evidence showed the need for a market-led tool to help really truly define the asset class to unlock the future potential of infrastructure as a driver for sustainability, a driver for resilience, and a driver for inclusive economic growth. The FAST-Infra label was established to support transformational systemic change in the development of this new global asset class. And when we can clearly demonstrate the link between investment and sustainable outcomes, we really begin to shift this narrative. We move from risk to opportunity, from complexity to clarity, and we begin to shift the capital to where it's needed. The label is managed by Global Infrastructure Basel, a secretariat, and Bloomberg as data portal providers. And I think there's folk in the room here somewhere. Just raise your hand. Come and see you guys afterwards. They're being a bit shy, but they're in the room somewhere. According to the latest Global Infrastructure Basel research white paper, the nascent sustainable infrastructure asset class, when compared to conventional infrastructure, has a potential for significant outperformance. And that white paper is available on the GIB website. It is forecast cumulatively over a 15-year time horizon to outperform more than 20% in the net zero scenario, and still around 10% outperformance in a scenario where there's limited climate policy action. That research also showed that an additional 5% allocation to sustainable infrastructure assets could boost overall portfolio returns by 20 basis points per year. It also showed that this sustainable infrastructure asset class, I wrote this, offers better longer-term risk-adjusted returns due to the lower exposure to climate, regulatory, and social risks, while improving portfolio resilience at the same time. So as we can see, all this evidence that I've just said, and there's a whole bunch of stuff out there, and you guys know this, this asset class is presenting one of the biggest investment opportunities of this century. This is precisely where the FAST label plays a really transformational role. By providing the globally recognized credible framework for defining sustainable infrastructure at the asset level, the label enables investors, developers, and policymakers to speak a common language underpinned by robust data. And we talked a lot about data and the Bentley systems, and Amelia talked a lot about data. That underpin, that clarity and that robustness is where you move from clarity, or start to bring clarity to complexity. You start defining what is sustainable infrastructure, what it means to stakeholders, especially private investors. As we mentioned, the role of private investors is absolutely crucial. Integrated across a full spectrum of sustainability dimensions and safeguards. The label enables projects to demonstrate standardized, verifiable, positive impact. It makes it easier for capital to flow towards real projects that deliver real-world benefits. It builds trust between public and private sectors. Trust, again, was a concept that Amelia spoke about as well. And it provides demonstrable alignment between today's decisions and tomorrow's outcomes. So that's the opportunity, but let's also consider the risk, because as investors, risk-adjusted return is obviously critical. But the traditional risk-reward models and financial models are being rewritten. Climate risk, transition risk, legal risk, reputational risk, these are all now financial risks, and increasingly becoming material to asset valuation and risk transfer options. But as we know, projects that embed sustainability are more resilient and offer a lower risk profile. And the reward is not just about returns on capital. When we invest in infrastructure that reduces emissions, restores ecosystems, uplifts communities, we create shared value. And that's the kind of reward that builds legitimacy, trust, and long-term outperformance. This is a classic virtuous circle, which attracts greater capital allocation, and success builds success. But how do we get there? How do we build this new successful asset class? Well, this is the exciting bit. This month, the FAST-Infra label team have announced that over 200 projects totaling $24 billion in capex across 20 countries are now in the process or have been awarded the self-assessment label. And these projects are in sectors which include energy, transport, water, waste, social infrastructure, and digital infrastructure. So in London Climate Action Week, that is real tangible action. It is actually a significant achievement, and it's a huge credit to the Global Infrastructure Basel team and the Bloomberg team behind the label and the portal. It's real action in real assets with real outcomes. However, to build on that success, as practitioners, each of us in this room, we need to think about building sustainable infrastructure as a differentiated asset class. So what does that actually mean? Well, firstly, consider the capital stack. We need to consider an alignment of interest. My favorite topic, as some of the folk in the room know, alignment of interest between asset owners, asset managers, and the actual asset performance itself. And that needs to be integrated up and down that full capital stack. Secondly, we also need to consider asset performance, so at the project level. We need to consider asset valuation and compound risk factors over the life of the asset. We need to stress test financial models, CapEx, OpEx, valuation assumptions over that full life cycle of the asset. As we know, here at Bentley Systems, we can now make use of innovative tech tools like digital twins, which can now run AI-driven scenarios to test models, and that's constantly evolving in terms of best practice, what can be done there. Thirdly, we also need to consider the project's value chain. So where are the risks up and down the value chain, including contractor supply chains, and especially within project design, procurement, and construction? And how can these risks be mitigated? So it's this multi-dimensional approach that's starting to feed into capital allocation, project finance, asset valuation, and legal contract practices, as we discussed actually just beforehand. Infrastructure can now be designed and financed using this fully integrated approach, underpinned by best practice science and evidence with credible and verifiable data. But none of this can happen in isolation. As I mentioned, collaboration is the engine of transformation. Sustainability needs to be considered by multiple parties and fully embedded in feasibility, design, procurement, construction, operation, and decommissioning. It needs to include public procurement, local communities, engineers, consultants, lawyers, sustainability experts, investors, lenders, insurance brokers, and underwriters to name a few. There's probably lots more I could mention. So is this alignment of interest between all these parties, which is absolutely critical, because the decisions we make today will shape the world tomorrow and for decades to come. And the FAST-Infra label can help with all this. Those 200 projects I mentioned earlier, worth over 24 billion in CapEx, is already supporting this alignment of interest in the capital stack, driving capital allocation to more sustainable, resilient assets. It is enhancing trust, credibility, and confidence in the market through robust, verifiable process with transparent data. It has established a market-led, globally recognized standard defining new sustainable infrastructure asset class. So with all that, and before I hand over to our expert panel discussion moderated by Robert, let me leave you with this. When we invest in sustainable infrastructure, we are not just building clean energy, hospitals, smart grids, regenerating ecosystems. We are literally creating the building blocks of a more resilient, sustainable, and prosperous future for future generations. So thank you for listening to me. And with that, I'll hand over to the legends, which are going to be here for their set, which I understand is packed with a whole bunch of greatest hits. So, Robert, over to you. Thank you.
Thanks very much indeed, Hayden. That was an inspiring piece there. You covered a lot of ground and really set everything out clearly. So we all appreciate that. Set the scene very well for our panel to come up. So I'm Robert Spencer. I'm the global lead for sustainability advice at AECOM. AECOM's a major multidisciplinary infrastructure enabler, if you like, environmental and engineering consultancy. So what are we going to cover in the next 45 minutes or so? Well, as you've heard, they've been trailed already. We've got a fantastic panel to come and discuss some of these issues with us. James Dunham from Dalmore Capital, Philippe Valahou from PIDG, Marcos Martinez from EBRD, Alexandra Chavarot from Howden, and Delphine Kenyard from Bankers Without Boundaries. Ladies and gentlemen, if you want to assemble, maybe sort of in the order of your names, that might make things easier, so people can see who's who. And I think just as well, I hardly need to reiterate. Now, you know, Hayden set the scene very well. We know infrastructure financing is extremely complex. We know we need to integrate global public and private. I'll just check on the sound. Okay, we've got mics for everyone. That's perfect. I'll sit down as well once I get going. Yeah, perfect. So just give our panel a moment to get organised. There we go. I think everyone's in position. I'll come and take a seat as well. It's quite scary, these little perches. I think we're all secure. Seatbelts on. Right, good. Well, we're tight for time actually, and this is going to be a deep discussion, so I'm going to get straight into it. This first part of the panel discussion is about 25 minutes, and I've got in my notes here that it's framing the challenge. But actually, when I've been talking to the panelists sort of in the run-up last week and just chatting this morning, I think it's more like overcoming the challenge, because when I've talked to these guys, they've already got great examples of where they're replicating, they're scaling up, they've got case studies that demonstrate to the wider community how to do this. So I think we're going to be really actually breaking through some of the de-risking of capital flows, and we're going to be looking at really how we get faster to sustainable outcomes. So I'm really encouraged by that. So I don't want to build you up too much, guys, but we have got some really good examples to come through. So we'll kick off with James from Dalmore Capital, James Dunham. James, you're a fund manager there. How appealing is sustainable infrastructure as an asset class to institutional investors like your own house? And can you briefly share some examples of where addressing material sustainability issues in the design or operation of infrastructure projects has led to a stronger financial performance? So can you show how sustainability in the infrastructure investment process has led to better outcomes, in short?
Absolutely. First of all, thank you for allowing me to attend and speak and give an asset manager perspective on this. I'm actually going to echo a lot of what Hayden was saying. We haven't coordinated on this, I promise, but as Hayden mentioned, institutional investors are inherently long-term with their thinking. They're looking for those stable, predictable returns over time. And I think from my perspective, sustainable infrastructure very much offers that as well and aligns with that mandate, but offers more. And again, as Hayden was pointing out, there's the opportunity for enhanced financial resilience, alignment with evolving regulatory and stakeholder expectations, but also opportunities for innovation and value creation as well. That's very important. But when I think about sustainable infrastructure, I'm not just thinking about those dark green assets, renewable energy, for example. I'm also thinking about transitional infrastructure, so assets which support, investing in assets which support the decarbonisation of high-emission sectors, infrastructure adapted to extreme weather and changes in climate, as well as enhancing the wider climate resilience of other social, environmental and economic systems. But also social infrastructure as well. Dalmore finances schools, hospitals, infrastructure which delivers that measurable community value. But what sets these apart isn't just that positive contribution. When we think about sustainable infrastructure, it's very much about the governance of those assets as well, how they're thinking about sustainability, the extent to which it's integrated within the organisational decision-making, and whether they understand the materiality of sustainability issues, both risks and opportunities, and how that's in turn considered within their decision-making as well. From an asset manager perspective, institutional investors are very much starting to ask questions around the materiality of sustainability for their investments. When I engage with investors, they're asking me how exposed are their assets to material climate risks and other sustainability risks. How are we thinking about this? Do we understand that? How are we engaging with these assets to manage material issues and realise opportunities? It's very much at the forefront of their thinking, and particularly with Dalmore as investors as well. And there's a role for standards and labels in this. And the best way to answer this when we're challenged on these things, when our investors challenge us, is through a label, for example. And this is where FAST has a key role, because it provides investors with that credibility, transparency and comparability, and confidence in the sustainability performance of these assets. And you asked about practical examples. I think a good example of how we're thinking about sustainability within our portfolio is a recent acquisition of a hydropower scheme, run-of-river hydro in the UK. And the impact is very clear. It's renewable energy that is inherent within the project, but it's more about, are there any other material issues? And the sustainability appraisal very much focused on other material issues, whether it's environmental or climate. And one key factor was the consideration of climate change. It hadn't been factored in, and it's something that we looked at. We developed change factors, considered that within the financial model, very much linking material sustainability issues to the financial performance of the asset. And from a Dalmore perspective, what this demonstrated was an opportunity. It hadn't been factored in. The climate change resulted in higher average rainfall over time. So this was an opportunity for Dalmore. This was quite an interesting asset from that perspective. And actually talking about the financial performance, the figures weren't far off what Hayden was talking about in terms of that benefit. So by Dalmore factoring this into the financial model, material issues, we're better positioned to make more informed financial decisions. And the key to this is quantification, linking sustainability performance with the financial model, and that in turn informing decision making.
James, thanks. That was really good. Really good understanding there of how the example with the climate impacts there that were originally missed. Some due diligence there seems to put them back in and actually enhance the sustainability of the asset and the financial returns. So, super. Appreciate you sharing that. I'm going to come to Philippe next. Philippe Valahou at Private Infrastructure Development Group. Philippe, how can blended finance unlock private capital by improving the bankability and risk profile of sustainable infrastructure, especially in emerging markets. So I'd like you to focus there. And can you give us a success story of where blended finance has enabled an infrastructure project that might not have happened otherwise?
So thank you very much, and thank you for the organizers for inviting me to be here this morning. So what I'll talk about for the next 5 minutes is the Kigali water project that we developed in Rwanda and which achieved COD in 2022. In its strategy, the government in its strategy paper from 13 to 18, the government of Rwanda had committed to providing universal access of water to the people, providing safe and clean water, and finding a way to attract greater private investment in the management of those water resources. And so the project itself included the structuring, the development, the financing, and the construction of a bulk water production facility east of Kigali, which today provides 40,000 cubic meters per day of potable water, reaching 500,000 people, which means you're reaching today 1/3 of the population in the city of Kigali, and managed under PPP, and I'll come back to. But as the project was being structured with the intention of building it as a PPP, there were quite a number of barriers that one had to overcome. The first one was obviously lack of commercial debt in the long term. We're talking minimum 15-year debt. And so when you think about our group and what we do, one of the first instruments that was set up 20 years ago is our debt fund, which provides up to 20-year lending to infrastructure assets in sub-Saharan Africa. These are private sector type projects. So this was one of the first challenges that would have to be faced. There was also a untested regulatory framework. A PPP framework and legislation had been set up, but it had not been tested in the bulk water space. And so that made investors and potential concessionaires quite worried. There were also quite a number of uncertainties around the governance framework. Prior to this project coming into play, both the water and electricity utilities were managed by the same government entity who managed and set tariffs for both. So there was a bit of an issue there, and working with the government, there was a decision made to unbundle the two utilities. And that was a key driving factor to ensure the success of the project, and to demonstrate the financial performance and credit history, which were until then quite unknown. The other key aspect was water tariff affordability, and we'll come back to that because that plays to the issue of blended finance. So how would you design the project to ensure that low-income households in Kigali would still be able to access an affordable tariff, but yet make this a commercial project that would attract a proper concessionaire or investor? And as I said earlier, Metito was the one that was selected following an international tender out of Dubai and operates today the concession on a 20-year concession basis. So I won't hide the fact that it was quite complex to put together. Initial support came from IFC and its advisory services in terms of the initial design and advice to the government how to structure a bulk water supply project on a PPP basis. And there was also capacity building for the utility provided by another arm which sits within the World Bank Group called the Public-Private Infrastructure Advisory Facility, known as PF. And then there was another entity that we provide funding to, which provides upstream services. And so we provided $1 million to it to provide capacity building to the government so that it had the capacity to negotiate with the parties across the table when the time came. Following the tender, as I said, Metito was appointed as the concessionaire. Our debt fund agreed to provide $19 million with a 19 or 20-year loan to Rwanda for this project. The blended finance piece came into the picture at that point where the concessionaire began discussions with us on the viability gap funding. And in the end, after discussions, we agreed to put in $7 million additional through our technical assistance in the form of a viability gap instrument, which would ensure that low-income households would be connected and still return a profitable project to Metito at a IRR that would still be acceptable. So for me, some of the issues that we took away from that, the early stakeholder engagement from the various parties, because you've got government, you've got local stakeholders, You've got the African Development Bank was playing a role because they came in with some funding as well. You've got the concessionaire with its own. But the concessionaire from the very beginning had boots on the ground, and so that made it quite easier rather than working from Dubai, and that was critical in ensuring the success. The other thing I would say is in each and every transaction that we do, we apply a climate lens, and this was no exception. And so for this one, for example, which is a critical piece, the control room for this project was built above the 1 in 100 years flood line. And so a couple years ago, when you had floods in Kigali, the plant was not affected. There was protection provided against flood events and submarine cable, therefore used throughout, which again prevented any damage when you had the flooding a couple years ago. But we also played a role in the restoration of riparian vegetation to stabilize the riverbank, reduce soil erosion, and prevent sediments from entering the water. So in every single transaction that we use, and sometimes we will put in some of our own technical assistance if we see a reluctant investor that may not have the resources or it wasn't included in financial model, we put in that additional capital because the things I just talked about did not add that much to the cost. So I'll leave it at that.
Thank you, Philippe. Thank you for unpacking that. It was really, really interesting to see how you brought together the different governance aspects, the climate risks, the capacity building, the stakeholder engagement. A lot of different layers of work had to be done to bring the deal together and to get this over the line and be a successful PPP. So thank you for illustrating that, and really, really good learning points. Hey, Marcos, I'll come to you next. Marcos Martinez from the European Bank for Reconstruction and Development. Of course, you're one of the larger international development banks, and it'd be good to get your take on the institutional policy gaps you're seeing as blockers to scaling resilient infrastructure. But flip the coin, and then if you're sort of halfway through your remarks, if you could say where you've actually helped de-risk some of that, and you've seen a breakthrough, and you've seen some investments that have resulted from EBRD's own sort of innovation around speeding things up.
Thank you, Robert. Nice to be here. Thank you for Bentley Systems and FAST-Infra for the kind invitation. Challenges for us, especially in the context of emerging markets, I would say that there is a lack of policy. In many countries, they do lack a proper policy, a proper strategy to address climate resilience. Some countries don't even have a proper long-term target for decarbonization. And obviously that hinders the interest and the appetite of investors, even us, really to invest in the long term. Second point, I will say weak institutional capacity, both technical capacity. You see public officials, even local companies that don't really understand. They see the benefits of sustainability and resilience in infrastructure, but they don't really have the capacity to make it done, and they are over-relying on advisors. There is also a lack of creditworthiness capacity. Okay, obviously you cannot really finance and develop projects where you don't have a counterparty that can really ensure they have capacity to make payments for the next 30, 40 years, which is the life of the asset. Another issue that we face a lot is lack of pipeline. Probably you go to many of these countries and they have a lot of ideas of projects, but they lack feasibility studies, they lack design. They are very early on the preparation, right? And you do really need to sit with them and with consultants, help them in having strategies really to prioritize what the investment needs and what is their what should be their first projects to achieve their objectives. Finally, this is honestly very broad, is the insufficient integration of resilience in the planning of infrastructure. Okay, we work a lot in Central Asia, you go to Kazakhstan, and I'll mention a project now, and you realize that their construction standards were developed by their Russia and Soviet Union literally 30 years ago, and they are still valid, and you still need to prepare designs according to those standards. So let me say what we are doing in that respect. So first, I'll mention the Green Cities program. This is a framework the bank has with 2 billion earmarked to invest at municipal level. All these challenges that I mentioned, when you look at the municipalities, are even bigger because the lack of capacity, the lack of credit worthiness, the lack of project preparation. So we sit with them. We have a framework of consultants that we know, we trust, with the standard terms, so we can really be very agile. And we look at what are their objectives with the municipality, okay, and what their investment needs. And we help them to prioritize, right? To say, okay, first do this park, second do this urban transport, etc. And then we transform that in what we call a GCAP, a Green City Action Plan. There are more than 70 cities where we work that have developed that. And then that's a roadmap, really, to implement infrastructure at municipal level. For example, in Moldova, in Chisinau, when we did the GCAP, we realized there was a big gap on, they have a huge portfolio of public buildings, and all of them were not properly maintained. So we invest 10 million from us. We also mobilize concessional financing from EIB, grant financing from the EU, and together we put together a 20 million debt package, not 20 plus grants, to retrofit the buildings. Okay, and with the retrofitting, we include windows, rooftop solar, and we also bring institutional capacity, because we also include all these technologies that measure energy in real time, and we train the public officials really to take decisions, right, and to manage the buildings, kindergartens, city council, that kind of building, into take informed decisions on how to manage the energy consumption in these buildings. Another example that we have done in Kazakhstan is a road, okay, a road between Akto and Bino. This is a 200 kilometers road. Same, we invest 200 million, and when we invest, we bundle obviously the financial product, but we also technical assistance and policy dialogue. So here we help them with the renovation of these standards that I mentioned before. We included design resilient principles, but we also engage with the Ministry of Transport in reforming all the standards, right? So they can really have criteria when they develop other roads, not financed by us, but all other roads with that look at floods, that look at a big problem they have with the melting of permafrost. So they have a lot of issues that they need to really reform. I want to stop here, but just wanted to give a couple of examples. Thank you.
That's fantastic, Marcos. Thanks for bringing those examples from the road program and the Green City Action Plans. I think they're really good examples which really demonstrate how you've had to do a huge amount of actual capacity building at the basic level around capabilities, around standards, updating, and that's the foundation for a lot of this work. So I think that we can't ignore that. That has to be in place in order for the rest of the exciting stuff to happen. Appreciate that. Okay, let's switch to the insurance perspective. I'll come to you, Alex, for this. What do you think are the key barriers from an insurance perspective that are preventing more capital flowing into climate resilient infrastructure projects? If you could unpack that by looking at what are the benefits of sustainability for insurance? How does insurance sort of calculate that into the mix? And what recent developments in infrastructure insurance are showing traction for you? You know, where infrastructure is benefiting from enhanced insurance through integration of sustainability into your decision making.
Thank you, Robert. All that in 2 minutes.
It's a lot. You can take 5. You can take 5.
Well,
Everyone
thank
else
you.
has.
Thank you very much, and indeed thank you to FAST-Infra for having me here today. Let me say to start that my background is as a project finance banker. And so in project finance, the key words are risk allocation. And traditionally, when we look at risk allocation to then mobilize limited recourse finance, as it's called, you ask yourselves as a developer, as an advisor to the developer, stroke investors, well, if that risk can be borne by the investor or the developer, and indeed if the lenders won't accept it, surely it has to be borne by the insurance community. And if the insurance community won't absorb it, it has to be borne by government. That's the traditional mindset. Now, I would put it to you that this mindset is no longer sustainable. Howden published last week a report called the Insurability Imperative. And if you read through the lines, it essentially signals, and it's not the first time that the insurance community is doing this, that the insurance world is not going to be capable of absorbing increasing amounts of climate-related risks in relation to the built environment, right? Yeah. If the insurance world is not capable of doing that in the medium to long term, by default, governments would have to absorb it, or indeed, by implications, there won't be any insurance, because government's balance sheet is also stretched, as we know. If there's no insurance, there won't be any loans, and I'm sure that other people on this panel will agree with that. If there are no loans, there's a question mark as to how to fund these projects going forward. So that's my scene setting, so to speak.
Yeah,
I think the second observation I'd make is it's important to unpick parts of that debate, because we have this perhaps somewhat simplistic assumption that we're here focusing on private sector-led infrastructure in relatively efficient markets where capital is abundant and where price signals work. Well, as Hayden mentioned, most of the capital required for infrastructure going forward is in emerging markets and developing economies. Capital sources are very different. They're constrained, and Philippe and PIDG are indeed addressing that gap, as well as EBRD and other MDBs. And I think it's a very different framework, whether you sit in the South, whether you sit in OECD, whether you're a private sector developer, whether you're a government official, and indeed whether you think that the funding comes from government sources or private sources. So that being said, let me try and answer your question. It seems to me that, as it was mentioned as well by James, the key here is to embed sustainability, and let's assume, or let's take climate risk as a proxy for that, for the purpose of this discussion, into asset valuation. This is no longer about ESG. It's about asset value preservation and potentially enhancement. So it's about understanding the costs and benefits of a counterfactual, which is do nothing about climate risk, versus invest in resilience. And how do you measure the benefits of that? Of the assets or through the assets as well, because there's wider ecosystem and systems benefits to this. There is a methodology that hopefully by day 4 of London Climate Action Week, most of you will now be aware of. It's called the Physical Climate Risk Appraisal Methodology. Anne Chatenier from the Institutional Investor Group on Climate Change is here in the audience. They've been championing this. They showed through case studies that investing in incremental resilience measures delivers value to the assets. Now, how do we link this to the insurance world then?
Good. I'm glad you're coming to that.
The insurance world goes by, as you would expect, insurance metrics. Now, I should caveat all this by saying I'm not an insurer, as you have talked by now. The two main metrics are annual average losses and probable maximum losses. That determines what's called the technical rate of insurance, which essentially is linked to the premium that you would pay for your insurance cover. So the key for the insurance world in today's environment is to create a link between vulnerability reduction and these insurance metrics. And so vulnerability, is part of the insurance assessment. You have hazard identification, you have exposure, and then you have a vulnerability quantification. And so linking vulnerability reduction, which is achieved through investment in resilience, to changes in insurance metrics is what the insurance community is working on at the moment. Second thing I'd say is then to engage with the financial community, both investors and lenders, to then create bridges between insurance metrics and financial metrics. And one thing that we ought to develop together is what I would call resilience metrics. Because after all, if you're the CFO of a infrastructure fund and you're being asked to invest X amounts of incremental capital to make an asset or several assets in your portfolio more resilient, how do you determine where to allocate that funding, which by definition is constrained? And how do you look at metrics or measures to calculate some sort of return on that investment? So resilience metrics would be, I think, very helpful. I'll finish by saying that this then leads into price signals. I think I mentioned insurance metrics reductions in ALs. I think they ought to be debt-related price signals for these assets, be it improvement or reduction in debt margins, be it increase in debt capacity, improvement in amortization profiles. And third, they ought to be equity-related price signals. If you're an investment, an infra investment manager, and you're looking to monetize some of your assets, at some point, you would expect that the buyer of an asset which is more resilient, which has been de-risked through incremental investments, will pay a higher price when you exit. Now, we ought to, and something that the FAST-Infra, I'm sure, can help address, find data for that and make the case that this is happening. At the moment, it's early days, but I think that's the direction of travel.
Thanks, Alex. You've addressed the question very thoroughly, and what I take from that is that actually you're working on these exact issues at the moment, and we should expect some further results very shortly that show how the linkage between the availability of finance and the availability of insurance is dependent on surfacing really effectively a signal around how the investment in infrastructure resilience will help prolong the ability of the asset to function. Good. Delphine, last but not least. You're Delphine Kenyard, Bankers Without Boundaries. I know you've been in finance a long time. I think BNP Paribas, it was where you spent a lot of your career. But you've broken free from corporate recently. Tell us about what you think are the innovative financial instruments that are showing promise for infrastructure development from your perspective, and what do we need to do to accelerate their uptake?
Thank you. So maybe for those who don't know Bankers Without Boundaries, this is a non-for-profit regulated firm which is powered by ex-bankers looking to work with public entities, governments, cities, and also corporates to mobilize private capital. So precisely our aim is to try to do something about this funding gap, and we work with all the people present here. The way we are trying to do things concretely is we've created two hubs. One is a European one, and another one is an Africa one, where we try to transform investment plans of particular entities into investable projects. So for the European hub, which is powered by the European Commission, the idea is to help cities transform their investment plans into smart city projects across energy, mobility, built environment, water, circularity, and so on. And when it comes to Africa, it's also about transforming infrastructure project, but also some health and key food, security needs into investable projects. And the innovation we see across all these projects has to do about precisely how we deal with the risk perception to attract private capital or other sources of funding. So in the case of Europe, basically the funding gap is such that cities will need 80% of funds to come from private capital to be able to achieve that net zero goals. And in Africa, as we know, private capital is more scarce, but it's coming, and there are lots of things happening. But also there are other pockets, such as concessional, philanthropic money coming. So by essence, the products we are working on tend to be quite blended. The hubs themselves are transactional driven and neutral. So they look to mobilize both the public investors and the private ones through a variety of instruments. So I think it's a bit all of the above that has been discussed, but I'll go into some of them or some illustrations. I think some of you mentioned debt funds to start with. So, for instance, we're working with the City of Leuven or the City of Bristol on green growth funds to help them attract capital. Usually there is an anchor investor we work with, and with the city. The city can either be a direct investor in the structure or not, just have a convening power. And through a blended structure or de-risking mechanism, we attract more capital to come in. In the case of Bristol, for instance, we've been involved in attracting lower investors, impact investors, whereas it could be more traditional infra funds coming into some other structures. Sometimes it is simply public to private SPVs, where you've got a public entity coming in and a private investor, and then if you want, lending to some other investors by creating the right risk profile precisely. So SPVs, PPPs, blended finance, those are obvious, kind of things. In terms of funds, we've been working in the Global South on a drought fund with the UNCCT, which is particularly interesting because it's an underinvested sector. Infra fund investors tend to look at water now more and more, so that's good. But funding drought issues, floods, that's much more difficult. So there you need to be quite inventive into the capital stack and the pipeline of projects you come up with to mix greenfield projects with existing ones to make it work basically and attract funds. There is also obviously all the fixed income.
A few more seconds,
Just maybe because you are asking me about instruments, there is a whole host of new type of bonds which have been created beyond green bonds, SLBs. It's very difficult to get, a city or government to issue actually an SLB. So, there has been a bit of invention here. And also the KPIs have moved towards resilience, biodiversity or resilient KPIs. So we've seen a couple of deals in the market recently around that. Even the EIB has issued a resilient bond. There are lots of outcome structures, debt for swaps, and so on. So we probably don't have time for that. But in terms of foundational
we'll dig into
changes,
that a bit more in the next round of discussion.
Okay.
So we can dig into the KPIs and the metrics a bit more.
Perfect. In terms of foundational change, I would really want to insist on the fact that you don't go straight to an instrument. We can't do product pushing. It doesn't work like that. So there is a need to really look at the potential pipeline and make it ready and convene all the parties. I think it has been said many times around the table and see who is the best one to take the risk. And what needs to be offered, what type of return they are looking for, and to get them into the project at the right level. And it could be that it's even sequenced. Some investors will come first and some will come afterwards. Some are going to be prepared to take riskier positions against a higher return. So the foundational change is really ensuring that whenever we have platforms to work, we create this ecosystem that allows, for me, this neutral structuring creation. That's very, very important, and that we never lose sense of the responsibility, the additionality created for the project, so that it's not just a ticking exercise where you go through a framework and you make sure that you tick X, Y, Z. No, we really, investors, they are going to look at the fundamentals. What's the counterparty? What are we investing in? What's the impact and the additionality created?
Thanks, Delphine. So we're going to move into the second conversation within the panel now. This one's much more around metrics, technology, standardization. It's going to be a bit more quick fire, because we've got to keep roughly to our allotted time. I know we lost a few minutes at the beginning, so we'll try and make that up. So if we can keep our responses to sort of 1 or 2 minutes, punchy. So James, I'll come to you first. What about sustainability performance metrics in your world? How are you using that to communicate the performance of infrastructure assets? And are they being used as tools to guide better investment decisions around asset infrastructure? Give us a sense of that.
Yeah, absolutely, Robert. I think from my perspective, they're no longer just a tool for compliance and disclosure. It's very much core to decision-making, whether it's the asset level or from in terms of how we allocate capital. So it's very much about understanding asset exposure to material issues, exploring how they may evolve over time, and the implications of these. And that's critical for reducing risk, to Alex's point earlier, and unlocking long-term value as well. And key to this, I'm going to keep re-emphasising this point, it's quantification, particularly in financial terms as well. And the reason for this is it's just as much about standardisation, allowing for that consistent, comparable method of communicating impact, as well as embedding it into financial decision making as well. And I highlighted an example earlier about renewable energy, where it's a little bit more straightforward, linking material climate and sustainability issues to operational performance. At Downward, we've got plenty of examples of that, but it's about looking at and doing this for all assets. So a good case study is actually a road infrastructure project, where the impacts and the material issues and how they impact operational performance in financial terms isn't as easy to identify and as clear. And what we've done there is focus more on the cost of impact and the cost of the response. So one of our assets, the portfolio company, identified that the extreme weather was deteriorating surfaces quicker than budgeted, and that was potentially going to result in a whole new phase of resurfacing, which would be tremendously costly, and something we were keen to avoid. So and they knew the cost of that, and were able to identify that because that was part of the maintenance program. But they worked with the technical advisor to identify a solution to treat the surfaces, to extend the life, and avoid that cost. And in terms of factoring that into decision-making in the financial model, they knew the cost of the response, they identified that, they knew the avoided cost of resurfacing, and that was fundamental to identifying material risk, managing it, and also giving investors confidence that these issues were being understood and robustly responded to as well, and very much formed part of the valuation process.
Thanks a lot, James. Really interesting there. Appreciate you unpacking that in terms of the avoided costs and I think we've just all got to get a lot better at understanding what these impacts are, costing them out, and it makes it much easier for the infrastructure investor to have confidence that this is under control and there's not too many surprises coming up. Thank you. Philippe, come back to you.
So the insurance industry is done then? It's done its work?
Yeah, absolutely, Alex. Yeah. Philippe, keeping with the idea of the standards then, and looking at how that can measure impact risk, can you give us a sense of how blended finance is approaching that? Have you got an example of where you're seeing some breakthroughs?
I'll just make a couple points, keep it to your 1 minute. If you look at our company, one of our product lines is early stage project development. So we put patient capital to take a project to financial close, COD, and then look to exit, recover the money plus a premium, and go invest into the next project. The ultimate objective to attract private investment into the markets in which we operate in Africa, Southeast Asia. And we have a transaction right now that's gone through the system in terms of the label, and meeting the various criteria. And it's very clear that the hypothesis that I've had is about to be proven right, and that is those transactions that achieve the label, therefore tell the market that it meets a whole host of criteria, be it governance, be it environment, be it sustainability, etc., is attracting interest because it has that vote of confidence. And so the two significant impacts for me, as I will be looking for to exit some of the projects that have achieved the label, is increased investor interest.
Yeah.
And more importantly, because a lot of the transactions will then go to expansion, part 2, part 3, and they'll be looking for funding. Indications are that from the lenders and or private equity boutiques we're speaking to in sub-Saharan Africa, that pricing could be affected positively because it will have that label. And it'll address a lot of the themes that you're talking about, Alex.
Yeah.
I'll stop there.
Fantastic. Thank you. Marcos, data and digital for MDBs. What is your response to that? How can that enhance project quality and investor confidence?
Well, one hand, standardization. Obviously, investors do like to find similar contract or the same contract, the same PPA they invested in one country to in another country with a similar risk profile. And then if on top of that you add labeling like FAST-Infra, that also gives that the confidence that someone before them has checked that the sustainability, the social, the biodiversity angles have been looked at the project. So that's obviously efficient and really helps private sector investment. And then in terms of digital, we discussed this morning a lot. We heard a lot about digital twins. This is something we are really using a lot. When we work with countries, when we prepare projects for them, we require that the future investor has specific requirements in terms of providing a digital twin, a tool that really helps to manage the future contract. We are doing that in a rail project in Czech Republic right now, in a hospital in Thessaloniki, in Greece. We did that in a very interesting project in Varna for a water distribution system that was leaking water. So they would only be able to invoice 30% of the water they were leaking. And we invest with them in developing this digital twin, link it with the SCADA and GIS, and then now they can really control the quantity of water, the pressure in the system. They can manage the pressure in the system to reduce non-revenue water. So yeah, I think digital twin was mentioned this morning, but it's a big tool. Also combined with AI, it's crazy the improvement that we can see.
That's brilliant. Good to hear how that's coming through, and especially in one of my favourite cities, Varna in Bulgaria on the Black Sea coast. Alex, come to you next. So here we're looking at standardization as well, but we're thinking about how, I mean, your industry is known for the amazing catastrophe models that you've developed over time for climate risk modeling. How's that getting standardized to better improve price standardization and protect sustainable infrastructure assets, or rather inform protection, perhaps would be a better way of putting that question.
Thank you, Robert. That's, I think, a very key question. I think what this addresses is the fact that we're actually dealing with uncertainty here. And we're all financiers, but I think we should all become statisticians to address this issue, in that it's about understanding the likelihood of an event occurring as well as its degrees of severity. So it's two distribution curves that need to be understood. Now that's the end of my statistical capability. But to come to your point, this is what the insurance industry is working on with data providers, with climate scientists. And it's translating the myriads of data that exist on this to make it intelligible and usable. Now, you could obviously aim to simplify by looking at sort of high, medium, low levels of probability. and looking at different levels of severity and then mapping the realm of possibilities that way. That's perhaps an oversimplification in some instances. But this is where, to the earlier discussion of digital twins and reliance on data, this is where it all intersects. There's no silver bullet here. The last thing I would say on this is that I think the insurance industry is also there to help stakeholders define for a specific asset what I would call the optimal point of risk transfer. And by that I mean you could continue to invest incrementally in sustainability and resilience, but as we all know, this is a shifting target, sadly not in the right direction. And so how do you determine how much to incrementally invest and therefore to reduce vulnerability, make your asset more resilient, versus transferring tail risks to the insurance market? Because after all, this is where the insurance market is pretty good at pricing risk. It's very good at pricing low probability, high impact events, right? And so doing that, working together with infra developers, investors, and lenders up front, not after the fact, not after the debt package has been finalized, I think is key.
Thanks. I think there's an important lesson for us there in my sector with ACOM in terms of infrastructure design, in terms of how do we work more closely with these models that you're developing so that the investment can be surer, because we've already put in the mitigation to the risks that have been exposed through the model so that everyone can feel a bit more confident that they're going to have less impact. Delphine, I'll come to you last in this round. And can you give us a quick sense of the infrastructure project criteria and risk assessment approaches that are unlocking faster, innovative financial models?
So I think it's difficult to answer these questions just with one answer, because it really depends on the regions and the type of projects you are trying to look at. In Europe, obviously, you've got lots of taxonomies. You have green bond standards. You have.
Do you prefer to give us an emerging economy example?
But yeah, exactly.
Yeah.
If you go to emerging economies, there is a lot more things to be done, fragmentation, and this is where we can try to look into the standardization mechanism. For instance, the BI has been looking into doing standardized blended finance models. Some other people would have other views on these models, but basically, if you want to target alternative investors who need to achieve investment grade, you can create some specific criteria where they know that in their structure there will be investment grade achieved. They understand who's the counterparty, what's the workflow and so on, and what is the impact sort of framework. In some cases, it's really new and there is a huge funding gap. It's more difficult. So you can't just achieve standardization immediately. You are just trying to solve the projects. For instance, we were working on a project in a South African country where we thought the issue was education, and we were looking into solutions to achieve, the right KPIs to increase the number of girls educated and so on. And we realized that, in fact, the issue was the girls were not going to the cities because they didn't have anywhere to stay there. It was a housing issue for them to get educated. And therefore, it shifted completely the way we structured the solution and also the capital we looked for. I could take really a lot of examples, but it's really important that you try to understand what you are solving, and then capital is here. It's just a risk perception, but also try to think about, what is the problem we're trying to solve? How can we make it scalable? If we tap public debt investors, they are going to look for very basic information, covenant lights, who's the issuer, and so on, and they will like very standardized frameworks. If you looked in the alternative space, you can have much more different type of discussions. Actually, I asked recently in front of me 2 types of investors, a public debt one and a private debt one, what they thought about insurance, credit enhancement, and so on. And one said, not interested, and the other one said, we only work with that.
Right.
And that's what we're looking for.
A lot of diversity in the sector there. And I bet you'll get some people coming up to you afterwards looking for examples of that documentation you referenced in terms of setting things out. So we're coming to the end of our panel before we get into some Q&A. So this is a quick fire round. It's one of those ones where we want to just get, what do you think is the next step that we can take to make things better, to move things faster? So in this sense, it's what do we need to do? What's the one bold action that you would recommend, coming from your perspective, that would shift this ecosystem to improve bankability, climate resilience, and sustainability in infrastructure projects? So a really tiny question for a tiny answer. But no, I think focus on one thing that you can do within your field to move the agenda. I think I've certainly been G'd up by, coming to Climate Action Week in London. One of the main things I get is sort of, the boost for the rest of the year, loads of ideas and thoughts that keep the energy levels up and keep us, motivated that we're doing the right thing. What's that for you, James?
Thank you. I don't think anyone's been surprised to hear that it's financial materiality for me. That being core to decision making, so a greater emphasis on that. It's not a peripheral issue; it's central. And that said, I do feel like there has been a shift that people are starting to think about this. That just requires greater momentum. Some investors are starting to ask this question. Asset managers are starting to integrate in their decision making. You're seeing at the asset that they're doing their best to quantify these impacts. But I think understanding the impact and quantifying it in financial terms is the challenge, and that's what needs to change. And it's about, Hayden talked earlier about alignment of interest. It's very much about aligning those interests, having shared expectations around this, and it being core to decision making, but also, as mentioned earlier, around standards as well, and developing those standards to complement those expectations, and that will result in greater flows towards more sustainable projects.
Thanks, James. Philippe, over to you. What are you taking forward?
I'm actually going to answer the question I want to answer rather than, if I may, but it may get to your point.
Go on then.
I've attended and spoken at a number of events this week. There's more to come today and tonight, and there's more to come tomorrow. And I said this to one of you, and I apologize for repeating it. I live in Switzerland. My daughter asked, what are you doing in London, and why are you going to Sevilla? And I said, imagine a swarm of bees that goes from one event to the next. And she said, well, how do you get anything done? If you're all talking to each other, how do new ideas pop up? And she was making a pretty powerful point. And my point would be, therefore, that the discussions that I've had over the last 3 days and will continue to have today and tomorrow, we're done talking. The solutions are there. The products are there. There's no need to reinvent. Use what is being used successfully. I may not have the answers to all because we don't. You will have some of the answers. Our friend on the left will have some of the answers. MDBs have a role to play. But we're done talking. I'm certainly done talking because otherwise I'm not coming back to London Climate Action Week, and I'm certainly not going back to Sevilla next year. And I think that ought to be the guiding principle for anyone who's participated this week coming out of it Friday.
I think you answered the question very clearly. Thank you, Philippe. Marcos, what do you take away?
I said blended finance. I think especially probably the countries where we operate, where there is an affordability gap, countries don't have capacity to pay for the full price. Having a solution where there is a blended investor providing concessional financing, obviously ensuring that the underlying asset is being prepared with sustainability principles, guaranteed by FAST-Infra, or other criteria. I think that will move the needle, to be honest, because again, it will make projects more affordable, and it will address the issue of the pipeline. But, so yeah, I'll go with that.
Thanks, Marcos. Alex, same question to you.
Well, it's back to work, as Philippe said. What's top of my agenda is to think how to develop and implement what I would coin resilience-linked loans, whereby applying perhaps a sustainability-linked loan concept, but going one step further, we find ways of financing resilience investment we identify resilience KPIs that are linked to these resilience measures, and we get the insurance market to backstop the achievement of these KPIs, whereby there would be a payout if they're not met, and the payout would be used to repay the resilience loans. So that's what we're working on.
Sounds really innovative. Thanks. Thanks, Alex. And Delphine.
Well, apart from putting up our sleeves and, you know, in this kind of a hub concept where you put the public and private side together, I think it's linking, we've got a lot of conservation projects, but we need to link adaptation to fundamental security and think about that, what it means in terms of resilience precisely, but food security, people's security, cities' security against flood, fires, and so on, but also, you know, social inclusion and so on. So it's the security theme needs to be rethought. And in the current environment, you know, there's a lot of confusion around defense, and people say, do we need to put defense into ESG, this kind of thing? No, it's fundamental, you know, individual and cities and countries' security we need to think about.
Thank you, Delphine. So that brings us to the end of the sort of formal panel discussions. We'll move into some Q&A now. I want to check, do we have Agatha Guot in the audience? Yes. Do you want to come up for a second, sit where I am? Because I did have a question for you. So Agatha is a representative of FinDev Canada. The CEO sits on our steering committee. And a question for you then. How do you see the role of development finance institutions in advancing the adoptions of tools like the FAST-Infra label to align risk, resilience, and return? What signals do you see that we need to accelerate that?
Thanks, and hi everyone. So I'm indeed with FinDev Canada. For those who don't know us, we're the Canadian Development Finance Institution. We're the youngest DFI out there. We're 6 years old and growing as fast as we can to help solve some of these issues. We're very involved with the FAST-Infra label, and it's a tool that we like very much because we're trying to grow specifically in the infrastructure space. So we're focused in emerging markets, given our mandate. And I think one of our key roles is really to try and promote it with our clients. DFIs are recognized as upholding very high standards, or at least we try very much in terms of ENS, governance, and resilience. So trying to make the label more known to our clients, insist on the use, and also with our partners. So Marcos stole my thunder, on blended finance. But for me, this is one of the key things in terms of concrete actions that we should be focusing our efforts on. And when we work with the private sector from the DFI lens, it's very useful to have a set of standards that they can look to, understanding that they're harmonized. One of the key criticism that we hear all the time is that it's difficult to work with DFIs and MDBs because we all have different sets of requirements. And I'm hoping that this can be one of the solutions that we can try and use to make everybody's life easier.
Fantastic. Good to see how you're integrating the label there. It's quite central to your approach. Okay, so let's, Hilda, can we go into some Q&A from the audience? How long have we got? 5 minutes? 10 minutes? 5 minutes. 5 minutes. Right, loads of I'll come to you first. So if you want to identify yourself and if there's a specific member of the panel who you want your question to as well.
Yeah, Tim Gosha, Dolma Group. We're one of the bigger FDI investors in Nepal, mostly DFI money, and working with PIDGE very closely on solar and battery storage and green bonds, and also FinDev. But my question is actually for Alex. Nepal has enormous renewable energy resources, obviously run-of-river hydro, also solar. It's trying to raise 46 billion over the next 10 years to meet export demand in clean energy to India and Bangladesh. That's a huge ambition. I feel insurance is at the heart of this, and I wanted to ask whether parametric insurance is something that might be a reality for an emerging market like Nepal. So I could imagine one of the risks is, of course, the glaciers are melting very fast, and you've got a 30-year hydro PPA. What if the glaciers aren't there to feed the rivers in 25 years? that's obviously going to affect the hydrology. So I wondered if you could address parametric insurance for emerging/frontier markets like Nepal, and also catastrophe insurance. Obviously, it's an earthquake zone. Glacial lake outburst floods are another potential catastrophe.
Thank you. I'll do my best. But for those of you in the audience who don't know what parametric insurance is, it's essentially an insurance that pays out in case a particular event predefined occurs, and the payout is not linked to any level of damage. So it's a fundamental difference with traditional insurance. And indeed, it's been developed over the past few years to and used by infrastructure assets, including renewable energy projects, to provide some level of minimum level of certainty of revenues or operating cash flows. It's been used, to my knowledge, particularly in the wind industry, where there's fluctuation in wind patterns. I'm not sure it's been used in the solar industry, but that's something I can explore. In the case of Nepal, my understanding, though, is that there are already government-led insurance schemes. There's a World Bank so-called CAT DDO scheme, which is a catastrophic deferred drawdown obligation scheme, where the Nepalese government would benefit from a very quickly deployed post-disaster funding facility from the World Bank in exchange for implementing actually government-led resilience measures at the sort of macro level. So for an investment in solar assets, and particularly if I understand your question correctly, you're linking that to exports of electricity to neighboring countries, therefore with international PPAs, which might be quite a challenge, but interesting. I would have thought, yes, there should be some ways to have some sort of parametric insurance. The key would be to identify what the trigger event is. The other aspect is to say, or identify what the depths of the market for that type of product might be, but something we can talk about.
It sounds like you'll have a good discussion over lunch. Next question. Yes, if we can go to the lady here first.
All right. Thank you. Alison Schneider, Senior Fellow with GRESB. I have a question. I'm formerly the Head of Responsible Investment at Alberta Investment Management Corporation, an asset owner. From an asset owner perspective, when I talk to asset owners, many of them look at emerging markets as too risky. They're not interested. And if you look at their statement of investment policies and procedures, the allocations to emerging markets are small, and they're not willing to look beyond that. What I found from a GRESB perspective is when we've dug into all the data, in the emerging market space for infrastructure assets and funds, the exposure is almost all in South and Central America and Southeast Asia. Africa hardly hits the, there's very few investors that have assets in Africa. So I'm just wondering, how would you address this? This issue of the asset owners of the world are not interested, for the most part, in looking at emerging markets, and where they are, they see Africa as uninvestable.
Who's that? Anyone in particular? You want to take that, or who wants to? Finny.
I'll kick us off. You might want. If I look at our debt fund, 20-year track record in Africa, today spread across 24 countries, implicit rating of the portfolio B, B minus. The rating agencies, and our fund is rated A1. Rating agencies tell me I should be losing 150 bips a year, a little more. Do you know what the loss rate is? 10 to 15 bips per year, maximum. So when I meet some of the biggest asset owners or pension funds in North America, very recently had meetings, and I said to the CEO what I've just said to you. And he looked at me and said, Philippe, that's great. I get an average of 12% return in North America over the last 3 years. Give me a compelling reason to go to my investment committee and tell them I'm going to invest in Zimbabwe, in Mozambique, in Sierra Leone, in Chad. Not happening. So there's a risk perception issue that we still have to deal with. I also think the middle people, the advisors to the asset managers, I call them lazy, and I hope there aren't any in the room. And if there are, we'll have a coffee or talk over lunch. If you're in their position, why would you sell an asset class that you don't understand? You're going to sell that which you understand very well and have been doing for 20 years. So that's the second one. And then if I look at the UK, because I'm part of the UK-led investor task force that was set up a couple months ago, prudential regulations and capital charges. And if you look at the insurance companies in the UK, if you look at purely from regulatory point of view, they can't touch Africa assets. So there's a whole piece of work that needs to be done on the regulatory side, which I think the UK understands, which is why that task force has been set up jointly with the private sector.
James, did you want to add a perspective?
No, Dalmore only invests in the UK and Europe, so I don't really have a perspective on that.
Okay. So you looked like you were leaning in. Apologies. You were next.
Hi, I'm Adrian Barnes from Green Arch Consulting, who are, among other things, an advisor to asset managers.
I knew there had to be one in the room, right?
So yeah, a question, I suppose, mainly perhaps for Philip and perhaps James. So the sustainability transition is quite infrastructure-led, and infrastructure investment is quite concentrated in private markets. Private markets are growing at an unprecedented rate, but are still, around about a 20th the size of public markets. Do you see an opportunity, or what can we do to leverage the power of private markets? To leverage the power of public equity markets into sustainable infrastructure? And is there an opportunity for things like the FAST-Infra Sustainable Infrastructure label to create a more commoditized asset class for sustainable infrastructure that will help drive it into the mainstream?
I'll say a little bit on this because I've been mandated by the partners at Dalmore to raise the profile of FAST because they see such an opportunity from it. And we've in the FAST working groups and forums, it's raising that profile from a private perspective. It's certainly on the agenda, and it needs to happen because I think there's that from Dalmore's point of view, there's an opportunity for us to differentiate ourselves by applying the label to our assets to recognise the broad contribution to sustainability of infrastructure, particularly in the UK and Europe, and a little bit of Canada that we invest in. That previously we've not struggled, but it's not been as easy to identify and communicate that impact, but either to lenders or to our investors as well. So I think there's a huge opportunity for private market uptake, and I would encourage my peers and I'm very much working the process I go through in terms of achieving the label. Yes, I fill out the forms and demonstrate the impact. I then, because the asset owns it, I then take it to the board and engage with them and to get their approval for it. And on that board are other asset managers as well and other investors, and they're starting to recognise the value of this and be part of that conversation in terms of the benefits of communicating sustainability impact of these assets. Also, its role in refinancing, reputational benefits, engagement with the regulator, other stakeholders. So I think there's a massive opportunity, and I've been very much encouraged to improve the recognition of FAST within private markets.
Thanks, Jim. Does anyone else want to come in on that point? All good? All right, we've got time for one more question. I think the lady over there in the corner. If you want to let us know who you are and come to the point on your question. Thanks.
Okay, thank you. Thank you. My name is Judith. I recently was working for the World Bank, but I'm working for myself now, trying to consolidate fragmented ESG solutions into one. So my question, I think it goes back to the question which she raised about investments in Africa and really raising the bar. Because I think we are creating a new problem or exacerbating an existing problem, because Africa is a source of many resources which we need in this transition. Therefore, by ignoring it, I think we're just worsening the problem in terms of access to resources which we need for transition. Then secondly, on the social side, we already have a problem about forced migration, where people are going where they think there are jobs, there's development. So if we don't develop in those regions, we are going to remain in a state of insecurity because people who are not supposed to be in certain places are going there, not using formal channels. So I think this Africa story, we need to really think about the products which we can put in place to see how we can solve the problem. Yeah, thanks.
Thanks, Madam. I think you make a very good point about the fact that some of the key resources, critical minerals and all that we need for our energy and our climate transition are right there, and so it can't be ignored. Does anyone want to come in with some thoughts on that final piece? I know EBRD is getting more into Africa. You've expanded your portfolio of countries.
Yeah, but honestly, we haven't really started yet. We are looking at what we can do, but again, always with these very sustainable principles. Honestly, Africa is very challenging, and we need to be super careful, honestly. But unfortunately, we haven't really started yet.
Anyone? Yeah, Delphi? And then
We are doing a lot of work, obviously, in Africa, and it is true that most of the investment comes from MDBs, and we're trying to crowd in philanthropies, but also looking into tapping the African investors. There are some platforms which are not only solely African, but which are very powerful, actually, and that can be leveraged, including family offices, private equity, and so on. So, in fact, it is developing, but you need to put your attention to it. Recently, I saw a transaction from an asset manager whose asset owner is an insurer, lending directly to a Togo transaction, and I thought, wow, it's very interesting, it's moving. And AFDB was providing a guarantee for that transaction.
thanks. Alex, if you want to come in, then Philippe, you'll have the final word.
I would also point out to some innovation in the insurance sector relating to Africa, such as the risk pool that exists, the Africa risk pool, which essentially allows to mutualize, and particularly climate risks across different African countries. That's been done in other parts of the world, in Caribbean, in Asia Pac, but Africa is certainly very much involved in that implementation.
I mean, I would say one thing. The one area where we've been obsessing about in recent years is localization. So when I see what's happening across the pond, and everybody knows what I'm talking about, some would paint a doomsday scenario. I see an opportunity. You still have 600 million, as Hayden talked about, without access to electricity. That is an opportunity. It's not a concern because of what's happening across the pond. And so for us, it's working with local developers in Malawi, for example. And then, we developed a solar power project in Malawi, which we exited 2 months ago. And who bought our stake? Old Mutual from Malawi. So, everybody fixates, for example, on the billions to trillions, forgetting that there's a whole piece of institutional capital sitting on the African continent. So, localized solutions is part of the answer. But then you need to achieve the scale to attract.
Thanks very much, and thanks for that question. Thanks for the questions all round, and my sincere thanks to such an informed panel. I really appreciate you all taking the time to share your expertise and your insights. It's been wonderful working with you before and just now as well. So, I think I'm handing back to Alex from Bentley, right? Or Mark from Bentley, even.
Thank you.
Sorry.
No problem. I mean, how do you sum that up? And I think special mentions to Robert for leading that panel. Absolutely well done, sir. So to close out, I'm going to actually use a statement and I'm going to build on it. It's a phrase I've been using since Singapore 3 years ago. Is the magic we're looking for and the work we're avoiding? Just let that sink in. And I think, Philip, you see yourself, we've talked, and we have talked. The solutions are there, the outcomes are there, we know what we need to achieve. We're able, and it's one of the reasons why I'm, as someone who started Crossrail on a Nokia 6210 after finishing the Olympics and then ended up in Canary Wharf, seeing the development of software, seeing the development of outcomes and solutions, those are there. I use the adage, when I was growing up at school, of measure twice, cut once. We can now build these opportunities digitally 4, 5, 6 times. We can rehearse. We can bring that resilience in. We can bring that security in. We can bring that mindset in. So those opportunities are there. And it creates even more opportunities because there's less waste carbon, less waste money, better outcomes, on time, less delays. So it's why we've become part of this family, become part of this relationship, because we're hoping to be able to bring our insight in to achieve more and achieve better. So with that, I'd like to not only thank the panel, thank yourselves for attending. There are some snacks available at the end, so please do stay with us, have a bite to eat, network, and hopefully we can cross-fertilise some more ideas and make some action happen. So again, thank you all for coming.